An extra 8,400, wow. And no accidents.
A Fox investigation reveals some little-known reasons why your auto insurance may be so high and some new hacks to help chop it down. More people have to save up until they're nearly 40 before they can finally buy their first home, and what the interest rate cut means to your next house. Plus, I've got the lowdown on the best day to book a trip for 20 to 30% less. That day is coming up, and Steve Noviello's got this.
If you've ever been hassled by trying to cancel a free trial or maybe a subscription, there is a new law that is aimed to protecting you. The Click to Cancel law. Next.
And welcome to Dollars and Cents. Thanks so much for joining us. I'm your host, Heather Sullivan. Now, we are all feeling it painfully. The cost of car insurance is soaring, but some drivers pay more for reasons that you might not expect. So we're going to spend the first part of this show doing a deep dive into what may be really going on with some of your insurance rates. As Fox's Craig Patrick found, some good drivers are getting unfairly punished.
Meet Danny Williams, a professional driver who's driven high-end clients and business executives in vans, limos, you name it, for the past 40 years.
How many accidents did you have in all those years?
0.
Not a one.
No.
Punched the wheels and the whole car flipped over, didn't even hit the sides.
Now meet Augie Mauser. His story is a little different.
I was chasing, these guys.
As a young man, he flipped his car racing after other cars.
Who was at fault on that?
I was.
Then later in life, he had some other mishaps.
Some minor fender benders, and as I kind of...
You've had some minor fender benders too?
Oh, yeah. Yeah.
But Augie got a break on his car insurance while Danny took a hit. $92 a month for Augie versus $160 a month for Danny.
Wow. Well, maybe I need to switch insurance companies.
Well, he tried shopping rates, but it didn't help. At first, Danny thought he might have paid more because he had a nice car, a relatively new Nissan Maxima. But then we told him Augie drove one just like it.
A relatively new Nissan Maxima.
Oh, dear.
See, Danny has something else working against him he did not realize.
It's very wrong, and it's hurting me tremendously.
He did not graduate from college and has a blue-collar job. And that cost him on his car insurance, even with a spotless record.
The system is broken.
So you're a PhD?
Yes.
Augie has a doctorate, ran a cigar business, and with no recent accidents, he got a much better deal.
I think it's unfair.
Years ago, a state investigation compared rates for white-collar workers like business owners, doctors, and engineers with blue-collar workers like mechanics, and it found a typical mechanic paid 3 times more. And the Consumer Federation of America found a similar gap in their recent research.
This distorts the market. It's not an accurate measure of how risky someone is to insure.
And there's something else about Augie and Danny we didn't tell you. We did these interviews with them 10 years ago. And guess what's happened since?
We stayed connected after that story.
That's how friendships develop.
I got to know Augie, and I got to know Danny. And they both kept good records.
It's been 10 years. Any issues, any claims, any accidents in 10 years?
Nothing.
Augie had one claim.
And there was a branch that was hanging there, and it scraped the top of the van.
Around 2018, you backed into a branch.
Yeah. So I made a claim on that.
And we found the disparity in the rates continued, with Danny consistently paying at least $70 more per month. Which brings us to how much more Danny paid in the course of 10 years. At least $8,400 and counting.
An extra 8,400, wow. And no accidents.
It's not right. That's not right.
Augie's doctorate in psychology paid off much more than he thought, and he says more than it should have when it comes to this.
As an expert in psychology, can not getting a college degree make you more likely to crash cars?
Not the fact of not having the degree.
The insurance industry says companies tend to charge drivers like Danny more based on data and statistics.
Well, the insurance companies claim that they have done tests and studies and found that your education level is linked to how risky you are to insure. But when we ask, can you show us like the evidence and the data for that, they usually clam up and say, we don't want to share that because it's proprietary information.
So I tried to change insurance companies, and yet still the companies I changed to, their insurance policies were even higher.
Augie thought of what Danny could have done with an extra $8,400.
You could use it towards the education of your children.
Which is interesting because in the 10 years since our first interview, Danny took out a loan to help put his son through school. And as he paid at least $8,400 more than Augie in insurance, guess how much he borrowed?
The loan was $8,400. To be exact, $8,400. What a coincidence, right?
Plus thousands more in interest.
Roughly about $4,000, because the interest is, when I got the loan, the interest rate was high anyway.
And higher debt can drive down borrowers' credit scores, which can drive up car insurance premiums hundreds of dollars more through the course of a year.
We looked at Florida, and we found that consumers with a perfect driving record and excellent credit, your average auto insurance premium was about $820. But if you have poor credit, you are paying an average of $2,000 for auto insurance, over twice as much. And that's astonishing.
We also found insurance rates can change for a married couple depending on which name they list on the policy first. We'll show you why and share some little-known tips that could save hundreds of dollars tomorrow night at 10.
Well, you don't have to wait until tomorrow night at 10. I'm going to show you that piece now. That was an eye-opening look at what may be driving up some auto insurance rates. But Craig didn't put the brakes on there. He is now going to town on some ideas you may have never heard of that could help lower your premiums.
Ruth Allen couldn't believe how much her car insurance bill shot up.
We've had no auto accidents. We've had no car violations. We've had no speeding violations, no infractions, nothing.
Ruth and her husband's premiums still rose 35% this year, or $800 more. But then they got a break simply by switching the order of their names in the policy.
Well, we were told that if we put my husband's name on the policy first, that they could save us $300 more.
Why?
I'm not quite sure. They're insuring the same people and the same automobiles.
Yes, but a lot of people don't realize how the order of the names can sometimes affect the price. While everyone in the policy is rated in terms of their driving records, policies are also rated based on other factors specific to the primary driver or whoever is listed first.
The only thing I can think of is that my husband is younger than I.
Car insurance costs more when we're young, then rates go down for 30 plus years, and then they go back up as we age.
Age probably is the biggest difference.
Mark Friedlander speaks for the Insurance Information Institute, an association and research arm of the insurance industry. And he says there are more than a dozen rating factors that determine prices beyond the primary driver's age.
Certain occupations are considered higher risk, for example, construction workers.
Builders tend to pay more than office workers. And while it helped Ruth to list her husband first due to an age gap, it often works the other way around.
If you have one male and one female on the policy, the female is probably going to be rated lower risk than the male on the same policy.
So with all other factors being equal or roughly equal, listing a wife before a husband can bring down the bill.
Gender is a factor because actuarial analysis of the insurance industry shows that female drivers tend to be safer and have less accident frequency than male drivers, and male drivers also have higher levels of DUI infractions than females.
But all of this can be outweighed by the primary driver's credit score. That can swing the price more than $1,000 through the course of a year. Here's a Consumer Federation of America study based on data from 2020.
We looked at Florida, and we found that consumers with a perfect driving record and excellent credit, your average auto insurance premium was about $820. But if you have poor credit, you are paying an average of $2,000 for auto insurance, over twice as much. And that's astonishing.
Your home address can also make a big difference.
Auto insurance companies charge people more, sometimes a lot more, based on the neighborhood or zip code that they live in.
Neighborhoods with higher frequencies of accidents have higher rates of insurance. Now, at this point, you may be thinking, well, you've given us a lot of factors here, so how do you know which ones carry the most weight in setting the price? And the short answer is we don't know. Each company puts a different weight on each variable, and they use different models to project a driver's risk of getting into a crash. And that's why it's worth getting multiple quotes and seeing how they can vary substantially between insurers.
And you could get 3 quotes that could be several $100 difference between the 3.
You can also let your insurance company track your driving habits and either pay less or more depending on what they see.
Some companies may ding you for bad driving habits.
Many will also charge more for insuring an electric car because they tend to cost more to repair. But that also varies a lot from one company to the other. And by shopping rates, you could save hundreds of dollars just from a couple of hours of work.
Different insurers also offer different discounts for seniors, veterans, active military, honor roll students for using electric billing or paying the bill in full or taking a defensive driving course. The key is to ask for all available discounts and take as many as you can. Craig Patrick, Fox 13 News.
And while we're on the topic of cars, the San Francisco-based company, best known for restaurant and business reviews, Yelp, just purchased an auto repair website. Yelp has announced that it agreed to buy Repair Pal for $80 million. That site provides car repair estimates for consumers across the country. And if you have been in the market to buy a home, you already know it is very tough out there, especially if you're a first-time home buyer. Low inventory and high mortgage rates are freezing a lot of folks out of the market. First-time home buyers have shrunk to a record low, and they're getting a lot older while they wait until they can afford to finally buy. Fox's Jerry Willis shows us what's going on here.
A new study showing just how much a pricey housing market is punishing first-time home buyers. According to the National Association of Realtors' 2024 profile of home buyers and sellers, just 24% of buyers in the housing market purchased their first home. That's the lowest level since the NAR first conducted the survey back in 1981. Typically, first-time buyers are about 40% of the market.
So for first-time home buyers today, it's an incredibly difficult market. There's very limited affordable housing inventory. We know that high rents, student loan debt, car loans, credit cards, everything's keeping these buyers from being able to save for a down payment and then find that perfect home. Unfortunately, because they're older, we know that that means a loss of housing equity over a significant time frame now.
The report paints a picture of a home buying market that is graying, getting wealthier, and increasingly paying in cash. The average age of buyers, 56 years, up from 49 last year. First-time buyers were 38 on average, up from 36 in last year's survey. Repeat buyers were 61. The proportion of purchases made with cash hit a record high of 26% in the survey period, July 2023 to June 2024. First-time buyers had a median household income of $97,000, up from $95,900 the prior year, and an increase of $26,000 in the last 2 years. Repeat buyers, meanwhile, had a median income of $114,000. Also setting a new high, the proportion of buyers purchasing a home for multiple generations. The top reasons cited were cost savings to take care of aging parents and children over the age of 18 moving back home, and children over the age of 18 who never left home. Though starting a family is typically cited as a reason for buying a home, only 17% of buyers had children who were still living with their parents. In New York, Jerry Willis, Fox Business.
Wow, that is a changing marketplace. And since homes are just so much more expensive right now, let's lighten up the mood. Let's book some travel deals. Travel Tuesday is the first Tuesday after Thanksgiving, and that is the day when you can snag significant discounts on flights, hotels, and vacation packages. The deals are usually 20 to 30% off. A recent Wallet Hub travel survey found 58% of Americans say they would rather spend money on travel than on retail. But if you can't wait until Travel Tuesday, the Points Guy says the good news is you can find some deals out there right now.
Good news is it's not too late to get a good deal. In fact, we're just about in that Goldilocks period right now when it's not too expensive and prices haven't started to rise yet.
Clint Henderson with the Points Guy suggests setting up alerts for your desired route and deals from your favorite airlines. And here's one more tip. You can usually save money traveling for Thanksgiving if you can fly back on the Monday or Tuesday after the extended holiday weekend. And holiday spending is projected to hit record levels this year. The National Retail Federation anticipates the average consumer will spend $900 a person. Experts recommend setting a budget to avoid the financial strain. They also urge people to shop early, talk to your family and friends about their expectations, and sign up for those price drop alerts. And did you hear about this? Non-alcoholic drinks are actually taking over the holiday scene. The fastest growing sector in the alcohol market actually has no booze at all. Sales of non-alcoholic beer, wine, and liquor jumped 32% this year. Non-alcoholic wines are made to keep the body and aroma of traditional wines with fewer calories and no alcohol. As more people are looking for healthier ways to celebrate, this market is expected to soar to $8 billion by the year 2030. So cheers to that. All right, Navy Federal Credit Union customers are going to be getting back about $80 million in overdraft fees. The Consumer Financial Protection Bureau says that it reached a settlement with the credit union totaling $95 million altogether. The CFPB says customers were charged illegal overdraft fees. They had insufficient funds when their transactions hit their accounts, but they say they had the funds when they made the transaction, and that's what matters. Now, stress related to the recent elections and other global issues is apparently influencing shopping habits, according to some new research. Credit Karma found 27% of shoppers are splurging to cope with stress. The report found Gen Z and millennials splurge the most when they're stressed out. In fact, 70% of Gen Zers said they are always online, and 53% said bad news drives them to spend. The report also found 1/3 of Americans say it's no longer rational to even save money because of world uncertainty. Now, that is some serious doom spending, so I hope you're not feeling that it's that bad. It shouldn't be. Okay, you may have noticed some prices for goods are starting to fall, but services, on the other hand, those are costing you more. A new federal report shows service costs were up nearly 4% in September from the previous year, while goods dropped about 1%. That includes things like eating out and insurance. Rising prices in the restaurant industry are linked to higher wages for workers. Insurance premiums have jumped more than 10%. We know that in the same time period. And spikes in rent have driven up housing costs by more than 5% in the last year. It's getting tough all around. But we do have some relief on the horizon. The Fed has again cut its key interest rate by 1/4 point, and that follows the 1/2 point cut that it made in September. So let's take a look at what this is going to mean for your wallet.
The overall public perception of the Fed rates dropped by 1/4% just days following the election.
I think it was wise. I think we needed it, but it wasn't excessive. I think it was prudent.
I think it's very good. I think we should help people.
Following a 1/2 point cut in September, a 1/4 point cut Thursday, it looks like a steady stream of progress. Yet,
unfortunately, the near-term relief for consumers is going to be pretty minimal.
Ted Rossman, a senior industry analyst at Bankrate, says that cut will have a minimal impact on consumers and borrowers, saying it'll only drop typical minimal payments about $1 per month. For example, car loans at a 7.5% rate versus a 7.25%.
We're talking $4 a month difference.
In the grand scheme of things, though, following a more than 5% hike in the Fed rate in previous years, we're still inching toward the U.S. Central Bank's 2% target.
The 1/4 point in and of itself doesn't really make a big difference. The cumulative effect could be significant. That's the big takeaway, is that the Fed pushed rates higher by 5.25 points in 2022 and 23. And they're starting to unwind that, but we have a long way to go.
But following voters' decision to elect former President Trump, who's been critical of the Feds and their urgency to drive down interest rates, maintaining their independence may be in danger, some worry. Jerome Powell took helm as the Fed chair in 2018, and things got rocky with him and Trump after his calls for lower interest rates went unanswered.
Trump wants lower rates. You know, he's talked about wanting to have more say in the process than really any president has had before. We'll see. I believe that Powell and the Fed will stick to their independence and their data dependence.
But with just a quarter-point drop so far, consumers say that's not driving them to make any big purchases just yet.
Yeah, not just yet. But Wall Street is certainly keeping a close eye on the cooling job market. Layoffs appear to remain subdued. That's good. There were 221,000 people filing for unemployment benefits last week, and that's up just 3,000 from the week before. However, it appears to be taking longer for people to find a job. Continuing claims in the week ending October 26th rose by 39,000 to 1.89 million. That's a sign that people are collecting unemployment benefits longer. Okay, so we've all been tempted by a free trial of something, but you know, canceling that subscription can be a real hassle. And now, by a narrow margin, the FTC has voted to make click to cancel the law of the land. Fox consumer reporter Steve Noviello explains what that means for you.
We've all been lured by the benefits of a free trial or maybe a subscription, things like free shipping, maybe you get a discount code, or even the idea that you can auto renew without having to take any action. It's a great deal for businesses too. They've got a really captive consumer audience. The problem though is, you ever try and cancel one of these things? It can be not quite as convenient. Well, now the FTC says companies have to make canceling just as easy as signing up was. So first up, the new rule requires that you don't need to speak to a live or virtual agent to cancel if you didn't have to do that to sign up. They also can't charge extra for a more convenient way to cancel. And even if a company required people to sign up in person, they cannot require you to cancel in person. They have to offer some sort of online option that allows people essentially to just click to cancel. What started all of this action by the FTC was really consumer complaints. They were trying to take a look at how to modernize the law as technology really outpaced it, and they opened up a forum while tens of thousands of consumers chimed in to say, hey, this is a really big problem for us. What the federal agency was looking at was actually a 1973 law called the negative option rule. Negative option marketing is an old and sometimes deceptive business practice that will interpret a customer's failure to take affirmative action to reject or cancel an offer as permission to be charged for goods or services. Now, the whole thing doesn't go into effect until 180 days after the final version of this is published in the Federal Register, but already companies, seeing that this is inevitable, are starting to make some changes. But between now and then, here's a couple of pieces of advice for you. First up, if you want to cancel a subscription or a free trial, particularly for an app, I cancel it immediately. The moment I sign up, I go to my subscriptions and I cancel it. It's not going to cancel the trial. What it will cancel is you having to mark your calendar for 7, 14, 30 days down the road to remind yourself to go ahead and cancel before you get billed. The second thing is to keep a record of any kind of cancellation. Maybe you record the phone call, maybe you take a screenshot and email it to yourself, some sort of proof to say, yes, I did cancel this. And third, if you're ever asked for any kind of payment information to initiate some sort of subscription or free trial, never use your debit card or an automatic draft from your bank account. It's too much access. You want to use a credit card. That way there's an extra layer of protection, somebody who you can dispute the charge through should you continue to get charged for a subscription that you've already canceled. We've got the full list of the new rule from the FTC right now on our station website. And when you come see me online, facebook.com/SaveMeSteve.
And finally, parents looking to be grandparents may want to save up. The website, The Senior List, found they spend an average of $4,000 a year on their grandkids, and some even admitted to giving the next generation $10,000 a year or more. That includes college funds, gifts, and other items. Now, spoiling kids just seems to get more expensive, but I don't know any grandparents who plan to stop. That's our show. Thanks for joining us. Drop me a line anytime on Instagram, Facebook, and X. It's all Heather Sullivan, Fox 26. I love getting your notes. And we'll see you next time right here on Dollars and Cents.